Alrighty, let's go ahead and get started. Welcome everyone to TradeFinder Live. Great to be back with you all during this trading day and during trading hours. First and foremost, as always, we do need to cover our disclosure disclaimer agreement. Main thing to take away from this is that we are not licensed investment advisors in the United States, so nothing's to be taken as personal investment advice. This is always available on our website to be read in full detail at your leisure, or feel free to take a screenshot of it now if you like, but that's the main point to take away. I have more headlines coming through today around the war, and that's with Jamie Dimon saying that the Iran war makes the Middle East peace prospects better in the long term. Interested to hear, excuse me, Rob's thoughts on that. We have more news around oil, which has been in the headlines for the foreseeable past or the previous weeks, and probably will remain that way for the foreseeable future. So lots of implications there in the markets. Very excited to hear Rob's thoughts on that, amongst many other topics. And of course, very excited to interact with you all. So let's go ahead and kick off. Rob, you out there?
Hey, I'm Zack. Hey, everyone. Welcome to TradeFinder Live. Hopefully, everybody's had a good start to their week. And we'll take a look at the markets. Get this up. I wanted to thank everyone that watched the U.S. market update over the weekend and gave their tributes to Mr. Norris. Sad to lose him, obviously, and certainly a rough day here. I've enjoyed all the kind comments and comparisons, and I hear it so often mentioned in the U.S. market update that I went to Lowe's on the day he passed away, and the guy said, I asked him, I said, hey, how's your day going? And he said, oh, not too good. I just found out that Chuck Norris died. And he goes, no offense, but you kind of look like him. And I said, no offense taken. Honored. So we did ask if y'all thought that we should continue with the shtick, if you will, the Chuck Norris hat and all that. And overwhelmingly, everybody said continue to honor him with that. So we will proceed that way moving forward. So with that, let's go ahead and take a look at what's going on with the markets. As Zack mentioned, comments from Jamie Dimon. We've got all kinds of different comments going on as far as what's happening with the potential end of the war, et cetera. And we'll just have to see how that all plays out. Certainly the markets were oversold going into the weekend, and that gave us the opportunity for this bounce that occurred yesterday. And then here we are right back down today. So, again, I'll talk about it, but I keep getting asked over and over again. So I'll repeat it as much as possible because it is such a good rule that no security in any time frame gets too far from the 10-day moving average, at least not for long. And in this case, clearly you can see that we were separated quite a bit from the 10-day moving average. And I wish I could give you an exact percentage on how far it is, but it's different from every security. Some securities are more volatile than others. Some tend to move away from their 10-day moving average a little more than others to get to the extreme level. So you do have to just kind of do some historical looking, what's about normal. And then you can see here with the SPY, we got down here. That was pretty good separation. Back up the next day, right back down the next day, back up the next day. Then up here, we got a little bit above it, came back down. Same here, a little bit below, back up to it, and on and on and on. And so you just get a feel for it. And I wish, again, there was some X hard percentage number that you could calculate with math and figure it out, but there isn't. But it is something that if you get good at it over time, it can really give you a lot of nice short-term trades just on the retracement back to the 10-day moving average, whether you were above it or below it. So at this point in time, we'll see where the market closes today, but where we opened, we were a little below it and sitting right on that 650 level once again. As I mentioned, if we broke 680 here, it brought 650 into play. And then if you're wondering what's the blue shaded area on here, somebody asked in the U.S. market update, where's the 38.2% corrective level? And it's right there at 625. So that's why this blue shading is on here. Another cool thing about the software is that when you use the fib retracement button, which if you're not familiar with how to do that, especially when you're looking for where could the wave 4 retracement be, you go back, you start it where the wave 3 started, you just click there, drag it up, click at the top of it at the 3, and it automatically draws this for you. And notice how it shades it a different color of blue so that you can see where the separate levels are of retracement. So just a lot of little cool features on this software. If you're new, if you watch the US Market Update and this is your first TradeFinder, the software is from hubb.com. You get the software for free. You can get the Elliott Wave signals for free. You do have an opportunity to subscribe to the AI signals if you want, but you don't have to do that to get the software and the Elliott Wave signals. Those are free. One last comment here on the SPY and we'll move on. We're starting to see on this big move down a little bit of separation here from the 10-day and the 50-day. That rule works the same as the separation from the 10-day moving average. The 10-day and the 50-day don't separate too far for too long, and they come back together. And you can just see how they've kind of tracked together through this entire upward move here. Got a little bit above there, not much, and came back down. But this is the separation here. There's the 50-day. There's the 10. It's starting to get to the point where perhaps we could get even more of a bounce than what we just got in yesterday's trade. It could go further. I'm not going to say that it can't, but I wouldn't think that we would have much of a risk of closing significantly lower today. We could. The markets could do anything, but on the low, we were a little bit below the 10-day moving average, and that separation is starting to build here. So I think, at least in the very, very short term, any further downside is just setting us up for a bit more of a bounce opportunity, and then we'd have to go from there and see what happens. But that's where we are right now on the S&P with the potential. And remember, the wave 4 doesn't always make it to 38.2. I like it when it does. We're getting close to 30. And as I mentioned numerous times, Mr. Elliott didn't like a 23.6% fib retracement in the wave 4. He didn't trust it, even though he knew it was a fib level. I shouldn't say he didn't trust it. He put it in the algorithm to label the wave 4 if we got there. So I guess that means that he trusted enough since it's a fib level. I should rephrase that to he preferred the wave 4 to retrace at least 30%, not having to get all the way to 38.2. Maybe we get down there, maybe we don't, but we are nearing 30%. So we're in an area from that standpoint where we could hold on the wave 4. It's still green, it's still active, so we could go lower. But again, in the very short term, barring anything very unusual that happens news-wise, I don't think we're going to take out this wave 4 low here on the short term. Down the road, maybe, but we're just talking about the very, very short term right now. VIX is staying elevated up here around the 25 level. I heard Jeffrey Gunlock yesterday, who, and I want to clarify this, he's one of the guys that I listen to for the bond market. I've talked about this before. TV's on mute right now. I listen to only a handful of people that when they come on, I'll turn the volume on. The rest of it is I just want to see if there's any breaking news or anything that shows up. And then I can go to a news service, find out what's going on. Other than that, it just stays on mute. And if one of those people come on that I want to listen to, then I'll turn it on. So Jeffrey Gunlock, I like for listening to the bond market. He's one of the guys. There's a few guys that are named the Bond King. He's one of them. I don't listen too much to what he says regarding the equities market. Stay in your lane kind of thing. So I listen for the bond market, and you can see this big outside day that we had on the VIX, which sometimes means a potential change of direction, getting a little separated between the 10 and the 50 on the VIX as well. But he wanted to see a big, massive spike in the VIX. He wanted to see a big washout event. And I can understand that. That's an old school rule that you get a big, huge spike in the VIX, and then you get a massive volume spike. I forgot to put the volume underlay here. I wanted to do that as well because I think that is interesting. I've showed you this before, but when we have these big volume spikes, look, every time there's been a big red spike, not this, not the solid average volume, but an outlying red spike, the market has rallied the last 4 times. You can see, and we even did it again yesterday. So does that rally continue on? I think there's a chance it could. So when you couple a big volume spike in the markets with a big spike in the VIX, you have a better idea that that's probably washing out the shorts for the short term. They're probably done. And then we could set up, the market usually moves in the path of least resistance. When everybody moves to one side of the trade, market tends to go the other way. And that's kind of what it's telling you with these big, huge spikes, a lot of shorting going on. And then that sets up for a reversal back in the other direction. So we'll see if he's right. But let's go to the bond market, which is more, quote, in his lane that I like to listen to his commentary. And the bond market has been a little troubling to me lately. If you've been listening, you know I've been concerned about the fact that prices, remember, prices and yields move inversely, and this is the indication of prices on the TLT, the 20-year. So with all this move down in price, that means yields have been moving up, and the yield curve has been flattening. So that's not what we want. We want the yield curve to start inverting, not inverting, steepening. Big difference there. We want it to, if you're short, you want it to invert, but for the long side, you want it to steepen. And we're down here getting a little bit away from the 10-day moving average here as well. Pretty vertical move. Maybe we're due for a time. Thought we might try to hold this area right here around 86.5. We didn't do that. So we're down to the next level here at 85.5. And the separation, pardon me, from the 10-day moving average and the big vertical move. Maybe bonds are going to take a break here and we'll start to get rates come in a little bit. That could be helpful to the equities market, should be helpful to the equities market. The only time it's not is when money is rushing into bonds because it's fleeing the equities market and it's running in from a short to safe haven, he tried to say. And then we see the big move up here on TNX. Now, remember, TNX is actual rates on the 10-year. So TLT's prices on the 20, TNX is rates on the 10. And that's where I was mentioning that the yield curve is flattening because rates are going up across the spectrum of the yield curve. From shorter maturities to longer. There was a little bit of a bid in real short term, but it wasn't enough to steepen the yield curve. So what this kind of means to me is the fact that whatever movement was escaping the equities market and into bonds went very short term, meaning that there's a viewpoint, at least in the equities market, that this conflict is it's got a short lifespan. It will likely end at some point in the not too distant future, and the people haven't run into the longer end of bonds, even with rates ticking up. So if you're bullish, maybe a little patience, perhaps things get a little bit better with at least a tradable bounce, and then we can see where things go from there. Dollar continues to cooperate very well. Got a little concerned here that we don't go too low. You've heard me talk about this before. They call this the Goldilocks channel. We don't want the dollar to go too far down. We don't want it to go too far up. Just right, hence the name, the Goldilocks channel. So just hanging right here in the midpoint is ideal as far as the dollar's concerned. If we get the speed or the vertical nature of this move is what worried me. We don't want to get to the point where countries around the globe are dumping dollars. We want it to still be viewed as the currency of last resort, that there's still faith that we can manage our debt even as it continues to pile up. So that's why I like the fact that we rebounded and we came up here, had a little bit of a triangle on the dollar, bounced up. And so all good as far as where the dollar is, nothing too nefarious so far. If we move to the metals, taking a look at GLD, continuing to move down, and as long as the rates are higher, there's a concern about stagflation. That worry is out there. And then in addition to that, we have an equal percentage chance is pretty low, but we have an equal percentage chance of a rate hike now as we do for a rate cut. So neither one of them are high enough in ratios to where it would lead us to feel like that's the next move of the Fed, a rate hike or a rate cut. But just the fact that there's even any percentage chance of a rate hike is a little concerning, and that's putting a little bit of a slowdown here in the ascent of the metals market. I've been mentioning that I felt at the end of the year that the metals would be higher, but if we continue with rates higher for longer, if we don't see the Fed start to inject liquidity like they told us, I showed that Fed liquidity chart in the U.S. market update over the weekend. If we don't get those things, it's going to be tough for that feeling to come true, and I may have to change my viewpoint. But that's what you do as a trader. You analyze the way you see things at any given point in time, but you got to be quick to say you're wrong and switch the other way. I'm not quite there yet, but if we break this level, I may get there and say something a little bit stronger out there than what I thought as far as concerns about stagflation, higher rates, etc. And then that would be a very challenging environment for the metals to move higher. On the positive side, we're a bit oversold here on GLD, had a vertical move down, all the stuff we just talked about, too much separation from the 10-day moving average, and the wave 4 is labeled right at a 50% correction. So that's part of the reason I was saying if we break that, that could change my mind. This would be a very logical point for gold to bounce if it's going to bounce. Again, I'm not saying that it is in the short term. I was viewing where we'd be at the end of the year. And then silver, I talked about this last week during TradeFinder. I thought this channel would hold. It didn't. So I was wrong on that last week, and down we go. But we're getting awfully close to a 61.8% wave 4 correction on silver. So both gold and silver are in areas where they could bounce. The concern I have on silver is you see this move, there really was no significant corrective move when we move from 50 to 60. And so this is kind of no man's land here. There is still a possibility that we go down to 50 here, but which is going to win? This little vacuum area between 60 down to 50 or the 61.8% fib retracement level, which in my view is the strongest of all fib levels. So we'll put it to the test. But to feel good about the metals, at least on silver, you got to at least see the SLV move back above 70. So we just went right through that little corridor that I thought might hold. So can this area hold or not? And if it does, it was trying to base here, but you don't even start thinking about the metals going up, at least not silver, until the SLV is back above that level at 70. Looking at the energy market, there's a bid back in oil, had a big move down yesterday. I've got some lines here that I felt were support lines on the way back down. That was a pretty vertical move up. What goes vertically up oftentimes comes vertically back down. So we had one big spike down yesterday, getting a little bit of a rebound today. But we'll see if this area here adds a support or resistance on the way down. We do know it acted as resistance on the way back down because we bounced up today. And I do think that we're going to come back down once that conflict with Iran ends. I think oil prices stay elevated. I don't think we run right back down here to where we were because it's going to take a while to get those ships moving, to get that oil to the refineries, et cetera. And this is more of a global problem. In the United States, we're getting pretty energy sufficient as far as both oil and specifically natural gas. Well, you know, we're awash in natural gas here. So the fact that those ships are stuck in the same strait, the same waterways as oil, didn't put a bid under natural gas anywhere close to the way it did with oil, as you can see. So still drifting down here in the price of natural gas. And if that doesn't put a bid in it, You can see this triangle here. We have a strangle on it for our EWO trader.com subscribers. See if we can get UNG to move a little bit further. We got a nice breakdown. So that was a good start. And we'll see if we can get some follow through lower, a little bit below the 10-day moving average on the low. But distinct downside breakout in UNG. And this bar counts as the breakdown bar. Some of you could say that is, but I don't view that one because we didn't take out these lows. So that doesn't count as a breakout from the triangle in my viewpoint. In fact, just to make it less of a thought process, we could just move that line a bit. And I know there's times I've mentioned this before, but it bears reiterating. I think people say, I don't agree with where you draw your lines on your triangles. That's fine. I don't really care because I'm not trying to be super specific. You could draw this line here, trying to get super technical on where they are. All I want to see is the bigger picture. Is it a triangle? Is it a consolidation pattern? Exactly where the lines go isn't that important to me. So this today would be the breakout day. So yesterday was the breakout day. Are we getting follow through today? So far, no. But where do we close? If we can take out that low and an ideal, just so for those of you again that are newer, a follow through or confirmation day, the ideal is if the close of the following day is below the low of the previous day. It still counts if you close below the previous day's close, but it's a stronger follow through signal if you close below the low, in this case, of the previous day. And then it would be the opposite if it had been an upside move, a breakout move to the upside, then you'd want to close above the high of that breakout day. So let's get to the crypto markets, which they're going to need that liquidity too, I think. We are trying to hold in here. We had a breakout attempt and we came back to test it. You know the three scenarios by now on triangle breakouts. They either break out and run, they break out, test the breakout, and then continue in that direction, or that initial move is a head fake or a false breakout, and then the big move is the other way. So scenario 2 and 3 still in play here on the cryptos. That's the BITB for Bitcoin. Here's the ETHW for Ethereum. They're identical. The ETHW did bump its head on the 50-day and then come back down. So setting up right through here, we'll just see if we can continue to hold this basing here. If we give that up, then we have significant more to go to the downside in the crypto space. But the longer we build this, the stronger it'll be. And that means that it gives us the opportunity for the blast off effect. So this is the launch pad, and then you get the blast off effect. Or when you build a good solid line like that and it breaks it down, that usually means a lot more weakness to come. So when you get one of these kind of horizontal consolidations, whatever happens after that tends to follow through for the short to intermediate term. And now let's move to some of the other markets here. Here's the DIA. I went ahead and drew the fib retracement there, especially because that wave 5 went to 160%, basically went to the 161.8% fib extension. And you can see now we're at not only a level here at 460, which is a 50% correction, but we're also in an area of support from October and November. So the DIA and the Dow are at areas where they could bounce as well. And then if they don't, if it doesn't hold here, then you start looking for something further to the downside. If this 460, whoops, didn't mean to move that. If that 460 level here doesn't hold, then we could be coming down to 425 on the DIA. But again, we're in an area that could hold. Let's see if it does. And then the Qs, which is a big one to look at because we tried so hard to hold that 6 to 610 level. And you can see for quite a while, almost 6 weeks, we just stayed right there and then bam, last week. We gave that up and made an immediate move back down to 580, which is where I had drawn this line. A little bit of resistance there back in the fall of last year. We tested it again here in the winter, and then now we're back at that level. Another area that could hold, but once again, that wave three little bubble there is green. So doesn't necessarily mean this is going to hold, but it's an area where it could hold. And we're a little separated from the 10-day moving average here as well. So it seems like there's a setup for a potential short-term bounce. You can see the 10 and the 50 starting to separate. But I'm not saying it's all clear. I'm not saying we're ready to rally or anything, just that we're still a touch, even with yesterday's move, oversold. And then the IWM. And when you get the stretches, when you get the moves away from the 10-day moving average, just another point to file away, they can go further away to the downside than they tend to go to the upside. So they can last a little bit longer. But we had this, and I talked about this. I tried so hard to find a good strangle on the IWM, but with the elevated VIX, pardon me, it was just too expensive and we couldn't do it. But there you go. That's why we like these triangles so much. They break out. And that would have obviously been a great trade, but it wouldn't have been as great as you might think because the cost was so high. Now, the VIX did stay elevated, which would have been helpful, but you'd have just been putting in a lot of money at risk. And had there been an upside breakout and then volatility came roaring down, you probably wouldn't have made much, even on a sustained upward move. Since it did move lower, it would have still worked. But again, it would have been putting more at risk in the position than we're comfortable doing. If you have a very large account, might not have mattered to you. But when we're trying to manage off a hypothetical $5,000 portfolio and trying not to put more than $500 at risk in any one alert, then that was just way too high. But it would have worked, and now we see, can the IWM hold here at 245? It's already back to its 10-day moving average, and there's a separation between the 10 and the 50. Pardon me. Heater's back on. Flipping around here in the mountains. We went from snow to 84 degrees in 2 days, and it's a little chilly again today, so heater's back on. And yesterday and Sunday I was sneezing because pollen was coming out. Poor vegetation has no idea what's going on. Everything was starting to bloom, everything was starting to pollinate, and then boom, and we get freezing temperatures again back down into the teens with snow, as I said, and snow and ice, and then right back warm again. So yeah, it's whipsawing like crazy here in the weather. But anyway, the IWM can try to hold here. If we don't hold 245, then when a zigzag ends, the first move, as you should know by now, is you retrace the C wave. So when a zigzag completes, that's what normally happens. You retrace the C wave. We've done that. So we're right here where B was. If we don't hold that, then what tends to happen is you retrace the entire zigzag, and that brings 230 into play. But that's if we break below 245, and we haven't yet. So you can see we closed above it here. We did close down there on Friday, but again, immediately back up yesterday. So no follow-through day is my point. And then we're trying to hold it here today. So we'll see where we close today. That'll give us some indication of what could likely occur over the next couple of trading days. So that covers most of the markets there. We will do a case study consideration as we do each and every week. There haven't been real definitive signals, and we've been a little bit light on our alerts at Evo Trader because of that. We need to see what's going to happen from here. But we're going to get a lot of setups, I think, coming forward, probably more in the impulse portfolio, the directional one, and the time strategy following these big drops. And we need that VIX to come back down to get really, really active in the volatility portfolio with the strangles again, because that's been the problem. There have been plenty of triangles. There always is in the market, no matter what it's doing. But when the VIX gets really high, sometimes they're just too expensive since you're buying a call and buying a put. So with that, Zach, let's go ahead and open up to some questions, and then we'll come back at the end and do our case study consideration for this week as well.
Sounds great, Rob. We'll get right into it. Got a question here for you to start out on AMD.
Oh, good. How long ago was it, Zach? Do you remember back in the time when AMD was seemingly every single event that we would do, someone
Oh
would ask
yeah.
about AMD? That was before all the big AI stuff started coming out, and um, we were looking at NVIDIA and Broadcom and all the other stocks. And then recently, it's been pretty focused on Micron and SanDisk. But AMD, this one's pretty interesting. Depending on your risk tolerance level, there is a wave 4 labeled there. It's green. It's right at 30%. So Elliott would be interested. But this is a very strong level of support, as you can see here at 200. It goes all the way back to when we gapped above it in October, held it in November, held it in December, held it in January, February, and now into March. We're continuing to hold this level. And this is another one of those cases where it's a shame, but it would be too expensive. But we do have, let me take the moving averages off just for a moment so you can see this a little clear. We do have a triangle here on AMD. And for triangle rules, you measure the width of the mouth of the triangle price-wise. So the widest part, where was the low? We'll just round it to 190, and then the high 220. So the difference between those two is what you expect on the breakout move from the point. We tend to take our strangles off before we get there because we want the highest implied volatility. And the last part, the last 20% of a breakout move of a triangle tends to be a little bit less volatile, and they start to take volatility out of the options, and holding it till you get the full 100% breakout usually doesn't make any more than if you'd have just taken it off when it breaks out 80%. So 30-point move likely coming in AMD, and no way to know which direction it's going to go. Don't get caught leaning that, okay, well, we're labeling a 5-wave to the downside pattern. We're going to break lower. We might. You can make a good case for it, couldn't you? 30 points to the downside. Now we start looking at maybe coming into this area, filling this gap from October, et cetera. That's a possibility. But it isn't going to break to the downside because there's a 5-wave pattern labeled. It could break to the upside just as easily, and there's a gap up here that could get filled as well. But something is about to happen on AMD. A larger account might make sense. I'd have to analyze the options again and see if 30 points is enough. Typically, you want the breakout to be 10% of what the underlying price is. In other words, if we have 30 points here, and it's a $200 underlying the equity, then is a 30-point move more than 10% of the current price? Yes, that would be 20 points or $20. So it could work there, but that last $10 could get eaten away from volatility coming out if there was an upside breakout. That's where the challenge comes in when you put on strangles when the VIX is elevated. It's not nearly as problematic if you break down like the IWM did. But we didn't know for sure the IWM was going to break down. So that's one of the reasons why we tend to only get really good scenarios when we put on a strangle on one of these triangles when the VIX is a bit elevated. So if you wanted to go long, I always talk about people have different risk tolerances. Some people are naturally more aggressive than others. Some are more conservative. You know where your own risk tolerances are, and I encourage you to stay within your comfort zone. If you're not real aggressively minded, then in this case, you're just going to be on pause here and let AMD show you which way things are going to go, and then you could trade directionally. But from an aggressive-minded standpoint, if you wanted to go long here, you could try to step in now, but 200 is your stop. And that's why it makes sense from a risk to reward standpoint that if you go long and it breaks 200, you get out. That's your stop. If you want to short it, I would let it break 200 first. And if we break down below 200, then you can enter in your short position. But right now, it's just wait and see and let AMD tell us where we're going next.
Thanks, Rob. Next up, we're going to have TTD.
An old trade desk. Really, really beaten up stock that it tried to hold. I think that was an earnings report. Well, post earnings. We got a big move up. Wish it wouldn't have been a gap. That's why I don't like gap ups. So back down, not only back down to fill the gap, but we're kind of coming down here to test that low around 20. And so what looked promising, tested the 50-day moving average, couldn't close above it even one day, and working our way back down. So you condense the chart and see where do we go from here. And it's pretty ugly. There's really no way to know. This is the old catch a falling knife scenario. Where is the bottom going to be? It could be all the way back down at 10 when we start to get to those institutional numbers, the $5 and $10 mark. Or are we going to put in a double bottom right there? So another watch and see here on TTD. If we can hold here and bounce, even a short-term bounce, I don't think means anything. To be meaningful to me, we got to get back above 25 here. At least that puts us back above the 10-day moving average, and then we still have the 50-day to worry about after that. So there's a tough row to hoe, if you will, for TTD to move back to the upside. And I'm sure people are itching to get into it because it just got crushed, trashed, whatever you want to call it, on the way down. But if we can start to put in a double bottom here and get back above 25, then maybe we have something. There's plenty of time if it does mount an upward move here to hold it all the way or trade it up to this 37.5 level. There's not much in the way there. Now we have this little point there, could act as short-term resistance. But we break below this. If we take out this low from February, then I have no idea where it could go from there. So this is, to me, a complete, regardless of whether you're aggressive or more conservative minded, it's a watch list. See if we break below that February low. And it has to have follow through, remember, because that could be a prime setup for a head fake. You break below it one day and you're thinking, okay, there we go. Katie bar the door, Zach, to the downside. But if it doesn't and it runs right back up the next day, that could be a prime head fake setup for a potential move higher. So a break below that February low needs a follow through day. If we're going to break higher, I think we need to get above 25 with a follow through day.
Thanks, Rob. Next up, we have ETON and the vertical movement around it. ETON.
ON, okay. Well, these pharmaceuticals, man, they're brutal because they can do this out of nowhere. This one was starting to work its way up higher before we got this big move, but now you see where my concern would be. Too vertical, too fast. We're getting a little bit of a pullback today, and that's where you get that 1 to 3 day reversal once you have one of these huge vertical moves. Will it come all the way back down to 20 and retrace it all? Maybe not. I don't know what the news is that caused it to go up. It was on earnings, obviously, but I'd have to go back and look at the earnings report and see why. I imagine there was something in there about a new drug or a phase 3 trial or FDA approval or something along those lines that caused this move up. But for now, I would want to see some backing and filling here. Again, it doesn't have to come all the way back down to 20, but somewhere back down into maybe 22 and a half starts to get a little bit interesting again if the news was something that could carry higher revenue forecasts moving forward. But for now, for me, there's just no way I can chase that move. And then part of the retracement's already happened today. But yesterday, following that, you could have stepped in, obviously, for that quick retracement move. But it's too late today, I think.
Alrighty. Next up, I know this is something you already covered regarding the SPY and triple Qs, but this question specifically is explaining your thoughts on the triple Q count versus the SPY and why they differ, and also with the triple Qs looking at the 50 or 100 wave count and not the default 300 or 377.
Okay, we can do that. The reason for the difference is they're different markets, obviously. So some of the big stocks within the Qs are in the SPY, but different makeups, so different patterns, heavily in the area of tech stocks, obviously within the Qs. But if we want to change this count, we said 50 or 100. 50 seems a little light to me. I rarely like to go below 100. If you don't have an Elliott Wave pattern on the 377, sometimes I'll look at 100, but they're kind of the same. Is it different on the 50? We can check that. Very short term minded, and the counts are really the same, regardless. So basically, we're just focused on this 580 level here on the SPY. I can go to the shorter time frames as well and see if that tends to make a difference. Notice that these charts recently relabeled. This was a 5 at one time right here. And so you retrace back down to where you're expected to go. Once that's satisfied, the algorithm, he tried to say, resets. What's the next likely move? So once we've done what we're supposed to, then the algorithm will automatically say, okay, that's done. Now what's next? But let's try the shorter term here on the SPY. We'll go to 100 periods here. And yeah, I'm getting pretty much the same results here regarding where we are on those different markets, even on the shorter term time frames.
Thanks, Rob. Next up, your thoughts on GEV.
Been a warhorse with what's been going on in the markets. Just continues to move higher. We're getting awfully close. We took out the wave 3 high, so we labeled a 5. We had a pretty solid wave 4, awful close to 38.2, kind of in the neighborhood testing the 50-day, and now we're moving back up. And we couldn't hold it yesterday on a close above that 3, but the high labeled the wave 5. Doing better today. Can we hold it today? And if we can start to sneak above this level at 900, we're pretty much in the tractor beam, which brings us up to that big round number of 1,000. And it seems like, barring something really negative, the conflict escalates beyond expectations, etc. Something really bad happens to where the whole market comes crashing down. It seems like GEV really wants to try to make that run up to 1,000. That's the watch that I would be on now. And there was concerning yesterday that we traded above 900 and couldn't hold it. If we can close above 900 today, then that's a stronger signal. And the fact that it keeps testing the 10-day on these moves is good as well. You don't have the big vertical stuff, and you have to worry about the short-term retracement there. Just kind of climbing up this 10-day And again, a close above 900 today, and then we'd watch to see if we get any follow through or appearing to tomorrow. Then I think that 1,000 level comes into play.
Thanks, Rob. Question, I guess from a macro view, does yesterday's changes give us insight as to which tickers would change and how they will change once the war subsides?
Well, if you listen to Tom Lee, he says as soon as the conflict appears to be over, you go back to cryptos. Obviously, he's a big crypto guy. That could turn and move higher, as well as going back to the Mag 7 or the Big 10, depending on how far out you branched on your big tech stocks. That's his viewpoint, what he stated yesterday, um, as far as where things could go. And I think that energy prices will likely be elevated for a while. So you could look at like an ExxonMobil or something. Might have a short term move back down with the price of oil, but you can see it's hanging in there well, because you would imagine the next quarterly earnings, which are coming up really soon here, are going to be pretty good. But we're already running up in anticipation of that. So we would have to watch for a little buy the rumor, sell the news event on their earnings report when it comes out. But I would, an area that I've been talking about that I think is going to stay strong, even when oil prices start coming back down, are the refiners like Valero. They're going to have as much business as they can handle for a while now, and you've got a little time before their earnings, and you could easily see that continue to climb higher, regardless of, like I said, it might be a quick blip like we had yesterday, but you see turn around right back to the upside today. I think this kind of movement continues in stocks like Valero moving higher, but I'll just kind of follow along with the AI signals and see what they're telling us, because they've got lots of macros, which would give you not so much susceptibility to these news events that come out so often right now, but more of a where are the stocks that are solid in over 300 data points, doing very well from both technicals and macros for an ascent higher. And they may not give you quite the same bang for the buck on the move back up as some of those big tech names that could retrace some of their beaten down moves, even though those beaten down moves were kind of needed for a lot of stocks that had crazy high valuations. So there's a few ideas there.
Next one I got for you is VG.
Venture Global. Not sure what they do, but they're obviously in a good space. We're getting a little vertical here. A little bit of separation starting here between the 10 and the 50. Not so much that it couldn't continue. More concern about the separation from the 10-day. So you can see what happened when we got separated here. Kind of came back a little backing and filling for a day or two, and then making another run today. Again, I'd have to see exactly what they do, but from a purely technical standpoint, breaking above that 15 level is key. It was right where the point of that descending triangle was, and also resistance when it tried to, whoops, wrong way, tried to take it out back here in September. So, yeah, it looks like that one might, we'll see what the DMI looks like there, but really good. And yeah, CCI even, yeah, that's across the technicals that we look for are supportive of this moving higher. Just wish it didn't jump so hard today. So maybe it takes off and runs now, because it did come test the break of 15 and that held. So that one, I don't know what it does over the next day or two, but longer term seemingly wants to go, seems to want to go higher. I think you're on a good one there.
Good old Palantir, PLTR.
Yeah, you kind of wonder. They got a little bit of a bid, with their ties to the Department of Defense or War, whatever your favorite terminology is. And then you have to wonder, as we start, there was the bid that came in. It got it above 150. So what happens when the conflict ends? This was one of those stocks that was insanely overvalued, but we took a lot of that out. We went from 210 back to 130. So obviously that brought the valuations back down in a hurry. But the key here is 150. If we can hold this, and we kind of sold off from the high today, but can we turn that around into the close? There's really no resistance till 170. So as long as it holds 150, I think you stay long Palantir, and then you gotta have to do a reassessment when we hit 170. Is there enough momentum to try to break that? Then it could take off and run. But for now, holding 150, as long as it holds that, you can stay long and hope for that 170 level and then see. But if it breaks below 150, that's your stop, because then it's going to come right back down and test that 130 level again. And so that's what I was wondering. If the conflict were to end very short term, before we get to 170, does that break it below 150, or does it hold and then still continue to move up towards 170? So 150 is your line in the sand. It's your stop. It could be an entry level, if it breaks below it with follow through, on a way back down to test 130. But most people ask long. So if you're long, then just keep an eye on 150.
ORBS.
ORDS.
BS is in Bravo.
Bravo. Not familiar with this one. 8Co Holdings. Okay, it's pink sheet stock. You can see here, OTC down at $1, and I don't know what happened, but is this one of those meme stocks that occurred back there in September? Because that was an insane move. And, this is why you have to be really careful about chasing those, because right back down in a hurry. My guess is it's kind of in the meme space or whatever, as far as what caused that kind of move. We go back to more of where we are now. You'd see that $1 is acting as support, and yeah, I'd have to look deeper into this, because this is a dangerous space to play in. There's no doubt you can hit some home runs here, but you better be quick to pull the trigger when you get one of those big moves, because you saw what happens when you see that. They don't last that long. That's kind of a GameStop type reminder right there. And the only reason that, in my opinion, GameStop didn't come all the way back down is they were really smart. They sold a lot of shares when they got those big spikes up, put a lot of cash in the bank, shored up their balance sheet so they could survive and figure out what they were going to do with their business model from there. I don't know that same scenario occurred with this stock, but it breaks below $1, and then nobody's really interested at that point in time, even from the super aggressive minded people. But it's a nice move today, and it could come back up to $1.50, or at least where the 50-day moving average is. But really tricky space. Wouldn't feel comfortable saying anything more about it until I learned more about the company.
Fair enough. I notice we're getting close to time and
Oh,
still
wow.
need to leave time for the case study consideration. We still got tons of questions, so perhaps one more symbol and then we'll go over to the case study.
Yeah, sounds good. Let's do it.
All right, from ORBS, let's go over to ORCL.
Yeah, Oracle's a good one to finish on. Man, that one's going to be borderline. Let's see how big this triangle is. Pretty nice set there. Um, Over the weekend, this was listed, not going to say the company's name, but as a top pick moving forward. It wasn't a company, it was actually an advisor. Um, and if you want to go long, you're right here at the area that needs to hold, right in that 150 area. And it could even drift down and test that low from February and still be okay. You take out this low. If you're wanting to be long Oracle, you stay long unless that low right there in early February gets taken out. Then, then you're out. Um, but a little bit of a triangle formation, nice set of higher lows if we can hold it today and perhaps even close back at the 10-day moving average. Um, and you could get a nice upward movement there. So the question that was asked earlier, when the conflict ends, et cetera, places to look, this will be a good one. So a good one to finish on, Zach. Um, so that I think you stay long Oracle unless you break that February low, then it changes everything. But that wave five is in a place where that could be the end of it. It didn't go 100%. So you got room all the way back up there to 225 where the previous four was. So there's a lot of good things to like about the setup on Oracle. Little bit of a hiccup maybe here at the 50-day. Might bump our heads at 175. In other words, not probably going to be just a nice smooth incline here. Some stair stepping on the way up there as we bump these resistance areas. So there would be one at 175 and another one at 200, but 225 could be back in the cards if the market calms down, the conflict is over, et cetera, and we start to get back to the more norms rather than being so headline dependent in the markets right now. So that, that's a pretty good one. So I think Oracle could be a good place to be. So when we look over here on these AI signals, we haven't done an official idea for a while, and that's been because, as I mentioned, we've been just biding our time, waiting for the right opportunities. You come down here and you see Tesla down at the bottom of the list. Now, if you're not familiar with how these AI signals work, you go in the direction on the higher scores. But when you have a lower score, you can fade it. Now, normally you want it to be down around 25 or below, and this is at 29. So it's on the lower end here. So even though it gives you an AI target, you wouldn't necessarily be trading this to the downside because that score is too low. It's almost low enough to where you fade it and go the opposite direction and you look for a continued move back up. And, even though Tesla's way more than a car company, but with oil prices elevated, et cetera, you got earnings coming on the 20th there, as you can see. So these little earnings bars not only or bubbles not only show you where the earnings are, but um, you can get estimates, et cetera, there. So it gives you the date of it. I would think that Tesla bounces back up here at least to 400. And I know that's not much of a move, but I think in this environment right now, it's prudent to shorten your time horizons a bit. So it's not enough, I don't think, to make this one an official idea as well. And it doesn't follow the rules. You can still have an actual alert or full blown idea when you follow the rules. But 29 is a little higher. But I think um, Tesla goes to 400, and then we'll wait and see. It's going to have a ton of resistance there. but I think that's pretty likely. And then on the downside, the AI had 408 as the fail zone, which would mean on a bounce if you were trading it to the downside, which you shouldn't be because of its 29 score. But that's right where the 50-day moving average is as well. So maybe we can get above that resistance at 400 and get up to 408 also. So we're going to look at Tesla to move up to 400 to 408. So again, that's just a post, not a full-blown idea. Zach, maybe next week we can get back to having some official ideas again. But shorter term, pick your spots. That's a prudent thing to do in this environment right now. So with that, we'll go ahead and wrap things up for today. Zach, I don't know if you wanted to show them anything on the website, or we'll just move on and wrap it up since we're past time.
Yeah, no, since we're a few minutes past time, I think everyone is familiar with the discussion board posting format. And as you said, we'll have a official idea here coming up soon. And so I'll provide an extensive review on both idea and a post and their differences when we are able to post that. So other than that, I think we'll let everyone get back to their trading day. Thank you all that took the time to attend live. It's always a pleasure to interact, and we greatly appreciate it. So back over to you, Rob.
Second that. Thanks for your time during this trading day, and we'll be watching the markets pretty closely as we move through the next couple of days. Just as a final reminder, we seem set for a better chance of a short-term bounce rather than significant move down, barring anything unexpected. But then that's just the very short term. Then we reevaluate and see where we go from there. So, so what I'm looking for at this point in time. Have a great rest of your trading day. Look forward to talking again soon.